Good morning and welcome to the Street's opening bell this Tuesday, November 1st. I'm Katherine Ross, in for JD Durkin. The opening bell was just rung by RXO to celebrate its listing on the New York Stock Exchange. And markets are looking to kick off the month on a high note as the Street looks to the start of the Fed meeting. Investors are largely expecting the Federal Reserve to raise interest rates by 75 basis points, with many betting that the central bank will take its foot off the gas in the coming months. And also fueling optimism this morning is a batch of better than expected earnings reports from both Uber and Pfizer. So let's turn our attention to what's on tap for today. The Fed is kicking off its two-day meeting. We'll also discuss the potential fallout, plus the earnings parade continues with a slew of big companies releasing quarterly results today. And finally, Biden is urging Congress to crack down on taxing big oil. So let's discuss what that could mean for the sector. So for all of this and more, I want to get to our Post 35, where we have Action Alerts Plus co-portfolio manager Chris Versace standing by. Chris, I heard that giggle. So markets are kicking off the new month in the green so far. Do you think that stocks can keep up this momentum?
Well, Catherine, when we're looking at the market, as a backdrop over at Action Alerts Plus, we do a combination of fundamental work and technical work. And in talking this morning with Bob Lang, who runs the technical side of what we do there, he sees very strong resistance at the 4,000 level and the 4,100 level for the S&P 500. Not surprising. October was a banner year, as we and others have been talking about. It was probably, the best October since, I think, 1976 for the Dow. But, the S&P rallied 8%, the NASDAQ was up, mid-single digits as well. So there's a lot of, hopium in the marketplace. And from a fundamental perspective, I think it really surrounds what markets are hoping the Fed might say coming out of that meeting tomorrow. But, as we pay close attention to the data and particularly what we saw last week, there's reasons to think that hopium could sag.
Well, and it's interesting, too, because October, we all know that it's one of the most volatile months of the year. And yet I was reading tweets from Callie Cox this morning of eToro, who was pointing out that the green that we saw really echoed 1937 and 2008, which are not years that you necessarily want to see on the board, but at the same time, it's good news overall. And I'm wondering how you think that sets us up for November.
Well, we have a lot to go in the month of November. Today's only the 1st, so obviously we have a whole slew of days. And we're kind of like only halfway through the earnings season. We've got 1,700 reports this week, and then before too long, we tend to see that pivot into retail land. And I think given what we've heard over the last several months about, concerns over consumer spending, bloated inventories, aggressive efforts to run down those inventories, my sense is it's going to be a challenging season. We also heard, Amazon talk about perhaps a softer than expected holiday shopping season. When you and I were chatting yesterday at this very time, I mentioned that the National Retail Federation is going to have their holiday shopping outlook call later this week. And I think that's going to help set the tone. But, by and large here, after such a pronounced move in the markets in October, I think a more cautionary stance is warranted, especially since, what the Fed says tomorrow afternoon could either make the rally or break the rally.
So I want to get to the Fed in just a second, but before we do that, I do know that you watch the ISM manufacturing data. You mentioned this yesterday. Now, this data does get released at 9:45 this morning, but ahead of it, what has the already released economic data told you about the macro environment? We kind of touched on retail, but I'm just wondering about the overall environment.
So at 9:45 and 10, there are actually there's two manufacturing PMI reports that come out. One is from S&P Global. They always have the flash PMI that came out several days ago that pointed to continued weakness in the manufacturing economy. And then at 10, we get the one from ISM. That's the one that more people tend to lean into. But that one is expected to contract month over month on the headline number. Now, given where we are with the Fed, the key to this report, in my opinion, is going to be what does new orders say, because that's a signal of what we're likely to see, in the coming months. And then second, the PMI reports tend to have some, new information, if you will, on pricing. So what are they saying about inflation, not just input pricing, what companies are having to, spend on, but what's the outlook for output pricing? In other words, are more companies inclined to try and pass through these costs i.e. more consumer-facing inflation ahead. So, I think we have to get through those reports, but let's remember too that last week, the GDP report for September came in stronger than expected, but on the other hand, the inflation data later in the week was also, continuing to be persistent. I think the market should interpret that to say, wow, the Fed has enough cover, like I was saying yesterday, to go bigger if they need to. And I think that makes today's data, as well as tomorrow's ADP employment change report for October, kind of, the last ditch effort to really cement what the market is going to think the Fed will do. I hope that was clear.
No, it was. And I think that pairing that with what you were saying in your morning note to Action Alerts Plus members, I read this note every morning. Now, you said that the market is overbought. I'm wondering if you can tell us how you're approaching this market from a portfolio perspective.
Right. So, again, over at Action Alerts Plus, we always mix the fundamentals and the technicals to manage the portfolio the way we do, but also to set us apart from just a fundamental product or just a technical product. So it's really that meeting of the minds, that Vulcan mind meld, if you will, between Bob Lang and myself that allows us to do what we do. I'm sorry, Katherine, can you repeat the question? I got all wrapped up in my analogy.
You're totally fine. How are you approaching the portfolio if this market is overbought, as we said?
Right. So again, strong move in the market, looks to be overbought, and we have this cusp for the Fed tomorrow. So, that resistance level is pretty formidable at 4,000, again, 4,100. So, we, as much as we enjoy what happened in October, and we were very active in the portfolio, adding new names, everything from Lockheed Martin to Clear Secure to Elevance, all of which outperformed the S&P 500. So we're very happy with that. We have to recognize, however, that resistance. And the big inflection point, like I said, is tomorrow. So we're not doing anything today, probably won't do anything tomorrow morning. And given that, there is some concern that Fed Chair Powell said, hey, guess what, folks? There will be pain ahead. We're probably going to keep our inverse ETF positions alive going through the Fed meeting, because again, there is that risk that this hopium balloon that's fueled the market rally winds up getting deflated.
Now, Chris, I want to circle back to something that you said yesterday as we kind of start going into this more Fed narrative. We talked about the pivot narrative. You don't think that's playing out here. The Wall Street Journal is reporting that the Fed officials could be eyeing a 50 basis point hike in December. Do you think it's possible that we see the Fed react to recession fears at all?
So, there's a lot of noise going around this morning that one of Fed Chair Powell's preferred things to look at is the very short-term yield curve today compared to where it is, 18 months from now. That would be for 3-month treasuries, and that looks like it might be inverting. So it's possible that the Fed might be contemplating this, but I have to go back to the fact that, Powell's comments earlier, Jackson Hole, and other meetings after that, he was very, very adamant that they will continue until they are done, until they see measurable progress on inflation down to the Fed's target at 2%. And again, there will be pain for both businesses and consumers. So I think they're going to continue to raise interest rates. My suspicion is that based on the data we get in the next, day, 2-3 days, we'll have a better sense as to whether it's 50 or 75 basis points in December. But I think we're going to go through this all over again, Katherine, by the time we come around to February, because we're going to have that much more data. And I expect that the Fed is going to say we will be data dependent.
Now, one thing we also didn't get to hit on is the recession talk. There's been so many headlines. I've lost count of how many people are calling for a recession in 2023. Should investors be listening when pundits are calling for an economic downturn?
So, the polling is always fascinating to me because it really hinges on how those questions are asked, what the alternatives are. Having said that, though, look, there is some concern that is happening. Certainly, companies are acting as if, they're getting ready for it with headcount reductions, other cost-cutting measures. What surprises me, though, is the disconnect between what we're seeing from, chief macro strategists at major Wall Street firms, but the calling for a recession or baking it into their expectations. But when we look at the consensus numbers for S&P 500 earnings, they're still up over 6% in 2023. So there's that big disconnect. And it makes me a little concerned because I think those numbers for 2023 kind of need to come down. But unfortunately, the market doesn't really key into that until December, January. So, my sense is, Catherine, we're going to continue to see a slowdown. Remember, too, that, the Fed has done quite a bit already, and they are planning to do more tomorrow, most likely do more in December. That means that, at the end of the day, entering 2023, the Fed funds rate is going to be somewhere between 4.75, plus or minus, compared to practically zero entering 2022. And I seriously doubt that we've seen the last of those, the last of the follow through from all those actions. We've seen it in the housing market, but we haven't seen it really ripple through every place else.
When you were talking, Chris, what stood out to me is it sounds like you listen more to the economic data that we get and what the Fed is saying than the JP Morgan CEO or Goldman Sachs CEO. Am I reading you right here?
There is no silver bullet, right? So you really have to take it all in. There's a lot of anecdotal comments that we get from, all sorts of companies that we kind of, bake into our, and I know this is kind of a trite term, but our investment mosaic, right? The landscape. And we have to remember that landscape is always evolving. It's not crockpot cooking, crockpot investing, excuse me. You can't fix it, forget it, right? Especially at times like this. If you think of 2022, there's so much that has happened, and there's likely to be a lot happening, in the next couple of weeks, the next couple of months. So there's a lot of evolving thought that we have to have. I will take data wherever, however I can get it.
Okay, and if we are headed towards a slowdown, how do you protect your portfolio?
So there's a couple ways to do that. I think we've done a pretty good job of it inside of AAP. We obviously built up our cash levels. We took more defensive positioning, not just with the inverse ETFs I mentioned earlier, but we were looking for companies that, consumers are going to use their products and services no matter what. There's also some long-term demographic as well as thematic drivers that are out there. And, we try to capitalize on, where we saw bright spots either in the overall economy or because of other factors that are out there. Case in point, and I think we touched on this yesterday, the Biden infrastructure law, the real push towards accelerating the EV transition, the need for charging stations, those sort of things. So that's kind of what we've been doing. Again, because we're always evolving our landscape, we're trying to look ahead, on a 3 to 6 month window, even though we like to hold stocks for, 12 to 18 months.
What kind of tone, you mentioned Action Alerts Plus, what kind of tone have you taken with your members around this recession talk?
So we've tried to prepare them as best we can, right? So far the data hasn't said, oh, we're in a recession. There was a lot of chatter early in the year about those two back-to-back GDP numbers, which, the economic cheerleader that he is, Fed Chair Powell, kind of brushed to the side. But we've been cautiously talking with members and saying, look, we're going to watch the data. We're going to continue to, position the portfolio. And we know that we're in a bear market, right? And you can see a lot of amazing short-term rallies. Again, just like the one we saw, and we saw several earlier in the year. So we've used the opportunity on those pullbacks to start to introduce new names into the portfolio, ones that we want to buy out, increase the position size, on weakness, because we want to get the best price that we possibly can. So it's kind of, waiting in, waiting out. But I think overall our tone has been a lot more cautious than, say, this time last year.
Now, Chris, I could talk about this recession talk all day, but I know that not everyone wants to hear it. So I do want to turn our attention to big oil. And President Biden has threatened to impose a windfall tax on big oil. Companies like Exxon are up over 70% this year. So I'm wondering if Biden's accusation that big oil was able to reap profits while Americans felt the pain at the pump was justified.
So it's kind of interesting, right? I did some looking at this yesterday, and I think if I remember the numbers correctly, according to AAA, gas prices now are only up about 10% or so year over year. But, the snarky comment, Katherine, would be, hey, isn't there a midterm election coming up soon? And, I think the outcome of that is really going to determine whether or not there's any bite to what Biden is trying to do or not. If the Republicans win, I think he's going to have a tough time passing that through, even though it would be a popular move to do something to help alleviate, that increase that we do have in gas prices.
So while we do know that the data is showing that Republicans are more than likely to take back the power in the midterms, Let's play devil's advocate for a second. If Biden does implement a windfall tax on these companies, should investors approach oil more cautiously?
So, to me, I'm always going to default to what the fundamentals are, right? Because, if the shortage happens, remember that in early December, the Eurozone is going to, push aside what it's been getting in part from Russia finally. It means that, the supply situation is going to continue to tighten further. There's also forecasts for, extremely cold winters. That's going to, drive the demand side of the equation. That imbalance could lead energy prices even higher. So it just means that, they might be taxed, but it's going to be taxed on a higher number. So I think, the reality is that we would need to see what this windfall tax would be, and then we can make a better assessment of it. That's assuming, though, that it comes to pass.
And I just want to get your general thoughts on oil here.
Look, we entered in with the AAP portfolio in a position with XLE shares because we like the dual exposure to oil and natural gas. But again, oil has kind of, it's, how do I say this? It's the evolving situation, right? So in the late summer when oil was under pressure, we were kind of looking ahead to several catalysts on the supply side that I just talked about. And so far, they look to have proved through. I think the question is going to be from here, if we see a mild recession, what is that going to do to demand? If we see a more pronounced recession, not just in the US, but also in Europe, what does that mean for overall energy demand? And that's the key to I think what's next for our position with the XLE shares.
Okay, let's turn our attention to earnings. Third quarter earnings season is shaping up to be a rough one, amid fears of a potential recession, as we extensively discussed already. Do you expect to see a similar story play out in the fourth quarter?
So, the guidance that we've been getting has been mixed. In the beginning of the earnings season, expectations were, good, better than feared. Last week was a little different, but we're starting to see more companies really kind of guide down. We're also hearing companies, talk about the inflationary pressures that they thought were going to peak in the third quarter, now maybe peaking in the fourth quarter. So I do think there's a little more concern, and we are seeing, some expectations come down for the fourth quarter. But again, it's a very important one for retail land, right? Because most retail companies make the vast majority of their profits in the holiday shopping season. So, I think once we start to hear from the first batch of retailers, we're going to have a much better sense as to how low the earnings expectations for the current quarter are going to go.
One stock that you guys had in the Action Alerts Plus portfolio for a long time was AMD. They do have earnings out later today. I'm wondering what would make you turn your attention back to this company?
So you have to remember there are really three big things that are kind of pushing against it, right? So the first is the weakness in the PC and the gaming market. Are we going to see that flip today? Probably not. Second is slowing spending on data centers. We're probably not going to see that turn around either. And then the third, more recently was the political action with the White House really trying to curb China's access to certain, bleeding edge technologies. And I don't think that's going to happen either. So I think there's more pain to be had, certainly more uncertainty to be had. And I don't think it's until, we kind of get through that and maybe see the PC market bottom out, kind of see continued demand for cloud services, driving the need for incremental data center capital spending. That'll be the time to get into AMD shares. It might be early relative to when the stock starts to perform, but it's when those things bottom out, that's the time to start looking at those names or names like that.
And let's go to names that have already reported. Pfizer reported earnings that not only beat, but they raised their sales guidance yesterday. And you talked about how you like healthcare companies. So how would you approach Pfizer?
So, we haven't really looked at Pfizer, to be blunt. We've got AMN Healthcare, we've got Elevance in there. But I did kind of peruse the earnings release, and I have to say, with the number of drugs, new drugs that they have coming on stream in the next 12 to 18 months in the double digits, it's going to be a name that we're going to take a pretty good look at because, one, we know it's far more defensive. We know that the demand is going to continue to rise along with that aging population that I talked about earlier. And if they've got that number of drugs coming on stream, if we can, figure out the timing on when they're going to hit, it could be a prudent move to move into that name before too long.
I'm going to refrain from using a cheesy pun here, but Uber stock was taking off this morning after it posted earnings with revenue beating. I'm wondering what your general outlook on the transportation space is.
So, I have to say, I'm not surprised. We're not involved with Uber, but I'm not surprised by, the numbers that they put up. And I say that because we have heard for the last, couple of weeks, as other companies have been reporting, whether it's, the airlines or the credit card companies, that travel has simply been off the charts, in some respects, even higher than it was before the pandemic. So, am I surprised that Uber has, continue to do better? No. And to me, the big thing that jumped out was, the mobility business, meaning that, yes, people are traveling. It's not just Uber Eats, which obviously exploded during the pandemic. So, I think the read into this is that at least consumer-facing transportation seems to be very good. I think when we get the economic data that we talked about earlier, we'll have a sense as to what the prospects are for other forms of transportation, whether that's, the trucking industry or the rail industry.
You mentioned things taking off in the pandemic, and momentum stocks such as GameStop, AMC, they really took off. We actually saw yesterday that GameStop was halted. I'm wondering, would you caution investors against getting back into these momentum names that are highly volatile?
Yeah, in a word, I would, because, a lot of this can be tied back to, again, the hopium that we've seen in the marketplace. And these tend to be very high beta stocks. So, if the market's moving, they're going to move as well. I like a lot more, data that I can wrap my hand around, as you know. So it's very tough for me to do that, especially when the core business seems to be, in a kind word, slowing, I would say falling. And we take a look at the most recent NPD data, and sure enough, gaming sales fell again in the last month. So it's hard to get excited about that.
All right, Chris, I want to turn us to rapid fire here now that we've covered some of the biggest stories of the day, starting with Senator Chuck Schumer's comments about the marijuana banking and expungements bill, which he said yesterday it's very close. Now, that boosted the weed stocks. Are there any weed names that you'd keep an eye on?
So again, sorry to be cheeky, Catherine, but are we talking close like horseshoes, close like nuclear bombs? What is close? Because we've heard this flirted, time and time again. So until we actually see it happen, I'm not inclined to dig deep into these marijuana stocks. There's been a lot of false starts in this, and I'd rather avoid that.
We also saw Chinese stocks like Alibaba and NIO. They got a boost pre-market as investors await a relaxation of China's strict COVID policies. If China actually does relax some of these policies, could that have an impact on any of the AAP stocks?
Yeah, so our exposure over there isn't very direct anymore. I think it would be an overall lift because remember, over the last several months, there's been a number of restarts, if you will. So, if to the extent that they relax the conditions, there's no longer such stringent lockdowns, it probably means that companies that do a lot of manufacturing over in China won't be, again, false starting so much. So for us, that would be beneficial for companies like Apple, which we heard earlier this week. There could be some, speculation on large production cuts because of the latest round of restrictions. So that would indeed be a positive, but I think it would it would help kind of remove some of the uncertainty that we've been, dealing with. So if it does happen, I would say, generally speaking, it's a positive.
And Johnson & Johnson, another name that used to be in the AAP portfolio, is buying a biomed for $16.6 billion. Buy, sell, or hold Johnson & Johnson?
The answer there is hold until we understand the synergies to be had with the transaction, what hole in terms of the product pipeline or service offering that it's really filling, but intrigued.
What's the one word that you want to hear out of Jerome Powell's mouth tomorrow after that Fed decision?
The one word? I don't know. That's a great question. Let me think about that for a second. If he had to say one thing that I would want him to hear, done.
Okay. ISM
I don't think,
manufacturing.
so hang on. But let me caveat that. Would I like to hear that? Absolutely, I would. Are we going to hear that? Absolutely not.
Okay, smart caveat there. ISM manufacturing did come in at 50.4, which is slightly above the market expectation of 49.9. Down, though, from September's 52 print. What do you make of that figure?
To me, digging deeper on those other, new orders and the pricing data will be key. But just based on the headline data, again, the economy continued to expand during the month of October. That's a positive for the Fed if it wants to go bigger.
When not a positive for us, we want to hear that word done. Chris Versace, thank you. That'll do it for the Market Open. Stick with the street for more on those and all the other major markets that matter to you.